Welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
Welcome to another episode of Defenders of Business Value. I'm your host, Ed Mysogland. This episode's going to be a little bit shorter, but it's packed with information. A lot of you have reached out and have provided feedback that, you know what, you really enjoy hearing about, market analysis, what's going on in the market. Not only, while our guests are certainly informative, a lot of the sellers that we work with want to talk about, tell me something more about the market. So about a month and a half ago, I did Deal Stats, which is one of the largest market data databases on the planet. And this week, I'm going to do BizBuySell. So BizBuySell, for those of you who don't know, is the largest marketplace of business sales as far as bricks and mortar, your small, I don't want to say micro businesses, but probably sub 15 million in revenue and below. And so each quarter, BizBuySell releases what they call the BizBuySell Insight Report. So that's what I'm going to share with you today is they recently released the results from quarter number 2. So the first thing I guess we should talk about is the high level. What are the things that have transpired? So the first thing is that business transactions have increased, 8% versus this quarter, so 2023 versus 2022. So second quarter, we're up 8%. Now, to put that into context, so BizBuySell sells roughly 10,000 businesses a year, or the brokers that post the businesses there. It's about 10,000, and from there, and that's off of a listing number of between, I believe last we heard it was between 50 and 55,000 businesses. So again, it's a dismal success ratio, but at roughly 20%, but nevertheless, there's 20% of those businesses that are selling. And in this case, it was 8% year over year. Okay. So what was interesting is that there was a 14% drop in prices. All right. And we'll talk about it here in a second, a little bit more in detail, but that was a big telling issue. And the issue has to do with predominantly cost of capital, meaning that it costs due to inflation and the Fed increasing the rates, it creates a challenge. And as a result, we're seeing that price, the valuations drop. Interesting. The next thing is interesting that the restaurants have regained popularity. And, I don't think restaurants ever really change. I mean, COVID certainly did a number on them, but aside, if you eliminate the COVID years, to me, by the way, this is just Ed's opinion, is I believe that COVID actually helped restaurants. Those that were able to pivot, move into delivery, ghost kitchens, things like that. I really think that they're thriving. So, and I think we saw that with COVID, that either they did, just okay, or they totally did great. And so while they were saying, restaurants are regaining popularity, and again, my opinion, I don't believe that it necessarily, I don't believe that it has ever really gone away. I just believe that COVID's in the rear view mirror. And I say that, and COVID's starting to rage right now, but restaurants in general, they're still there. It just happens to be that people are now buying them because, we're far enough away from the pandemic that they can see how the financial results actually are. Lastly, the last key point was that baby boomers, continue to pass the keys to corporate refugees. And that's I'm quoting from the Insight report. And we're seeing the same. We're seeing that there's a lot of people that either not necessarily been displaced, but those that want to have a greater control of their destiny, those that have left, the corporate workplace, they're looking at buying businesses. So that's consistent with what we see here in our practice. So let's go a little bit further into the Insight report. So the first thing is, the second quarter acquisitions climbed by 8%. All right. And that was quarter over quarter, which was a 4.8% gain over the first quarter. Again, I think you're seeing a lot of 2022 year end that got kicked into 23. And I believe that, there's, once you pass a threshold, like a year end, every buyer pumps the brakes and they want to take a look at, okay, what did year end look like? And chances are there was some retrading, there was some, adjustment in purchase price, and good or bad, but nevertheless, I believe that's what led to the increase in why there was an increase in total acquisitions. So back to value though, the median price dropped by 14%. And again, probably, a year and a half ago, I mean, we're at 5% money, as far as borrowing money, 5-6%. Now we're bumping up to 11%. That to me is why the prices are dropping. And so we're seeing that, there is a challenge as it relates to how much money you can borrow. It's not necessarily that the value of the company has changed. It's just your borrowing power has. So what do? You got to be creative. If you're on the sell side, it's now a new, anticipate that there's going to be some creative financing. Maybe that's a subordinated seller promissory note. Maybe that's an earnout. Maybe that's a self-canceling note, things like that, where you're bridging the gap of that value gap. And so this is for those of us that have been in business for as long as we have, and in our case, it's 41 years, and I've been in my role 31 of those 41. I don't want to say it's business as usual, but that's what we do. Is we come up with structure and a means for business owners, to exit, while at the same time helping the buyer create a deal that has mitigated as much risk as we can. So both buyer and seller are getting the best deal from both ends. Okay, so now let's talk a little bit about seller financing. That seller financing has always been a component of most deals. And when I say that, in small business land, we don't have a whole lot of businesses that have audited financial statements where there's an assurance of the financial condition. You'll see reviews, you'll see compilations, but that's really about it. And so what creates the problem is, if I'm a buyer, I want some assurances that those earnings will continue to be there. Number one, are they there? And number two, are they going to continue? And that's back to business value. So there's three components to business value. And I've said this 100 times. It's about earnings, it's about growth, and it's about expectation. Those are the three components to making valuation work. And when we start talking about, seller financing, a lot of that is a risk mitigating tool for the buyer. And so what we're seeing is that there's the buyer. And again, this could be part of the, tail end of COVID, where there was some volatility. Certainly there was volatility. And now the question is, when you came out of the gate after the pandemic, is that proxy for what's going to happen going forward? Or, what is the new normal for you? So BizBuySell had surveyed buyers, and 43% of them tend to use the SBA, and then 70% intend on asking the seller to finance part of the deal. That to me is not a surprise. And so part of the problem we tend to bump into is our sellers. Our sellers, they think that they, meaning buyers, should just automatically take their word for it and move down the road. It's not that simple. And we continue to bump into that problem where I should get all cash at closing. Well, you're not providing the assurance that the buyer needs in order for that to happen. So most sellers, and in this case, only 22% of sellers plan to offer seller financing. Those are the types of sellers that are probably going to be stuck with their business if they don't cooperate with the buyer and the primary lending vehicle, or whether that's the SBA or conventional financing. Those are problems. But seller financing has always been a key component to every business sale. Okay, so now let's move to restaurants. Restaurants, they're going up. 10% transactions rose 10.3% over the previous quarter of 3.2%. And so it's interesting that more people are getting into them. Now, having been in the business as long as I have, I can tell you that there's a lot of people that buy restaurants that probably have no business buying a restaurant. And the reason I say that is people just assume it's a simple business. All you do is hand people food, or you prepare it, and they totally underestimate the complexity that goes into running a restaurant. And I would submit that a restaurant, and whether that includes liquor or doesn't include liquor, I will submit to you that to me, that is probably as complicated of a business as manufacturing. And manufacturing people will be mad, but nevertheless, there's a lot of moving parts in that restaurant that the business buyer initially doesn't fully understand. So as we look at this, we're seeing an increase in restaurant transactions. All right, so a lot of the business sellers that are in the restaurant business are sitting here saying, okay, I survived COVID. I want out. And so we're seeing a lot of that kind of turnover. So restaurants are part of that retail sector. It's theoretically, it all falls into retail, whether you're talking a restaurant or an actual retail business. What's interesting is that retail businesses as a whole, it shouldn't be surprising. It's declining. Now, if you're listening to this and you own a retail business, it's like, okay, well, what am I supposed to do now? Well, okay, so the businesses, what we're seeing is that, if you have a niche, it's one thing. If you're competing head to head with Amazon and you don't have some sort of means to, whether that's service or something that Amazon can't provide, it's going to be a tough road for you to sell. It just is, because no one wants to fight the behemoth in the industry. So as we look at the retail subcomponent, I think what we have to keep in mind is, it's going to go down, and the volatility of the retail sector, just the bricks and mortar type retail stores, it creates a challenge. And the people that we're consulting right now from a retail standpoint, it's what makes the most sense. Can we get anybody to recognize the goodwill in the business, or is the goodwill going to evaporate quicker than we anticipate? And how do you facilitate that? I mean, there's certainly different ways. A lot of retail businesses are probably best suited to going out of business sale. That takes 6 months, and they continue to bring in new inventory, and they tend to make out better. And we're planning an episode all around that here in the next month or so. The second kind is, lending. You don't get the kind of collateral value you get that you historically have gotten. And so therein lies where we have another need to bridge the gap, the value gap, by using seller financing. So we're hoping we can get credit for goodwill. We know there's going to be a shortcoming of collateral using the inventory. And as far as the tangible assets, the fixtures and shelving and stuff, it's just there's just not a whole lot of value there. Okay, so now we move into buyers, and this has been, as I read this report, I mean, anytime there's a bump in the economic road, we see the same thing. There's a somewhat of an exodus, and our buyer pool increases with business owners or prospective business owners that want to take control of their life, of their professional life. And so we're seeing a lot of those types of buyers that are, I think they reference corporate refugees. Same kind of thing. Everybody is it might be easier to control my own destiny than to hope I don't get displaced by the man. And that's been going on for forever and a day. I do believe that the buyer pool will continue to broaden. As far as we have not seen any change in the decrease of reasons for sale. The primary reason people are selling is retirement. And I don't foresee that to not be number one for at least the next 3 to 5 years. Okay, so as we move into rates, at the time of this recording, I mean, it's going for 11.5% money. And that just beats up deals. It just does. It's just the cost of capital is really aggressive, and it's hard for all the pieces to fit where the seller's maximizing their value. The buyer is able to have a capital structure where they're able to make the kind of money that they made when they left corporate America, service the debt, and get a return of and on that investment. Those are the three components that they're looking to get. And when you increase the cost of capital, that debt service really goes up and starts eating into the compensation that business buyer is trying to have. And as a result, you see that you can't afford as much business as you used to do. So what does that mean? Well, I typically, if there's a new administration, regardless of which side of the aisle, I do think that you're going to see that the rates will decrease. I don't think we're going to see them at 5% anytime soon, but nevertheless, I do think that they're going to decrease, and we should be able to be in a position to fix a lot of value gap that we have been experiencing. The other thing, and this is on a side note, one of the things that we've been advising our clients to do is to do, say, a 1 or 2 year note with a balloon or a condition to refinance. And that's not a bad way to go. Now, the second thing is for those of you who have EIDL loans, EIDL, EIDL, the federal, those companies, you got PPP money for for employee retention, and then you had the economic disaster relief. So the EIDL loan, that's 3% 30-year money. That's assumable. So if you have an EIDL loan hanging out there, it may solve some of your cost of capital problems. So look into that. That's a good way to bridge that value gap. All right, the last thing is, as we come into third and fourth quarter, it's still a good time. It is as good a time to sell, and it's as good a time to buy as it ever has been. And for me, I don't believe that buyers are necessarily taking it on the chin, nor are sellers. I do believe that there's collectively that where business is overpriced. I don't know. The market is the market. I have no idea whether that's the case. I can tell you market multiples, they just change slightly now, but earnings are what drives value. So as I look at those types of businesses across our portfolio, to me, I believe that we're still in a great time for good deals to be made by both the buyer and seller. And as always, if there is anything on our end that we can help, I will tell you when I have to turn on the meter. The door is always open. We've been doing it for 40 years, and we're happy to help in any way. So I hope you enjoyed this episode about BizBuySell market insights, and we look forward to talking to you next week.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.